So how is it how is it on the West Coast today?
Yeah, it's good. Uh, Weather's really nice. I can't complain.
Yeah,
How about
we've been
how's it going on the East Coast, North
it's
Carolina?
nice. It's been super humid, which I've been enjoying.
Yeah,
Next week I'll start going on some longer runs again. So maybe I won't be enjoying it as much then.
yeah.
For this week when I was just out enjoying the weather, it was actually really nice. Um, so no complaints. And
Good
then
stuff.
this weekend I'm gonna go up to Asheville.
Yeah.
Uh it's like a beautiful little mountain town, so it'll be really awesome.
Okay. Good stuff. Well, it looks like we got we got a few more people left to join. So we'll just uh, give them a few more seconds here, and then we'll get started. So thanks for your patience.
Um, yeah, I know there's usually some like difficulty if people are switching from like Microsoft Teams to Zoom. Uh,
Totally. Yeah, I feel your pain.
uh,
I used to use Google Meets, and now
yep,
whenever anyone asks me to join Google Meets, I'm like, why am I so big? Like, where are all the controls?
right. Or like I keep my computer like pretty locked down. So I'll sign into the meeting and like my microphone doesn't work, my camera doesn't work. So then I just like have to like while I'm supposed to be live, I'm going back through trying to like get everything set up. So it always takes me a second.
Definitely.
But yeah,
Okay.
it shouldn't
We're,
be too long.
we're gonna do 30 more seconds, and then we're gonna dive in. As people are trickling in, that's totally fine. We're gonna start with I promise that we're gonna get straight into it, but we're not gonna spend a lot of time at a high level. There's gonna be a lot of really, hardcore, strong information leverage tax strategy that we're gonna be sharing. So just 30 more seconds, and then we'll get started.
And we are going to do that question and answer period at the end. So we will go over
Totally. We,
the
we
specific
are
questions
we are
that
100% going to answer questions that people submitted before before the meeting, before the webinar, and then if people have questions throughout the webinar, feel free to drop them in the Q&A section at the bottom of your screen there. And I'm going to say, Cal, what do you think? Let's get started.
yeah, let's jump into it. We might have a couple people that come in a bit late, and that's fine.
Okay.
Uh, it's like everything. We understand life happens.
Yeah.
But yeah, let's definitely try and respect everybody's time. So let's
Okay.
get into it.
Yeah, definitely. All right, Phil, looks like you just joined. Great. Okay, so Digby, this is the Digby Real Estate Tax Webinar. We started Digby to help real estate investors with their taxes. We thought that it should be simpler and cheaper and for the 99%, not just exclusively for the rich. And so that's why we started this company. Kelly is going to dive into the agenda for us and talk about what we're going to cover.
Yeah, so absolutely. So we're gonna start out. We're just gonna give an example of kind of the power of some of the strategies we're going to talk about and show you why you should care about it. Next, we're going to talk about offsetting that W-2 income and really how we got to the example that we're going to show you. Then we're going to show you how to leverage depreciation. After that, go into bonus depreciation and how you can really supercharge that depreciation. Talk about cost segs, who needs them, how you can benefit, and if you need help with those. And then we'll do the live Q&As with some of the questions that have been submitted and answer any questions that you guys might have along the way as well.
100%. So why should you care? Like, why should you listen to us, right? What credibility do we have to be giving you this information? So I'm Sean O'Keefe. I'm a real estate CPA. I've been doing this for 10 years.
My name's Kelly O'Keefe. I'm an enrolled agent. I've been with Digby for about a year and a half now. I'm also a real estate investor who was attracted to the company because I had some of the same issues that you guys are probably feeling, where it's super expensive to get into the tax market. Tons of questions that aren't always straightforward when they should be.
Yeah, perfect. So immediately after this slide, we're going to dive in to why you should care, give you a high-level tax strategy on how you can save big money on your taxes. Before we do that, our lawyers wanted us to read this disclaimer, so just bear with me for 20 more seconds while I read this to you. This presentation is provided for illustration purposes only. It does not provide personal tax legal, financial, or other professional advice. Your situation may be different. I think that's completely fair. Consult a professional for information concerning your individual taxes, financial, or legal situation before taking any action. Now, let's dive straight in here because I want you to understand what we're going to be covering. And so here's how it works. Imagine that you have a rental property with $30,000 in rental income, expenses of $60,000. That means you have this $30,000 loss. There is a way where you could offset your non-passive income. So that's things like your W-2, your 1099, with these losses from your rental portfolio. So instead of paying taxes on 150, W-2 income is in this example, you would only pay taxes on 120 because we use these losses from your rental portfolio to offset your income taxes. So that's a $30,000 of of income that didn't get taxed as a result of these rental losses. Now, so this is the high level. Now we're going to fill in all of the pieces of how you can do this. How can you use the losses from your rental property to offset your non-passive income. I'm going to start off super high level, and I promise you we're going to ramp it up and get more and more complicated very, very quickly. But because we have a lot of different levels of real estate investors attending this webinar, I want to just lay the foundation in the next 30 seconds, and then we'll ramp up to the more complex strategy. So the first question that most newer real estate investors ask is, what expenses are deductible? And given the slide that I just showed you, where we're showing that you can leverage these losses to offset your non-passive income, it's probably pretty important that we understand what expenses could make up those losses. So here's a pretty good list of the expenses that you can deduct on your rental property. All of these are cash basis, which means that when the expense leaves your bank account between January and December, you're going to deduct it on your tax return. The only one that isn't is this depreciation expense, which I have bolded and circled here to highlight it. This is a non-cash item. And so what does that mean? Essentially, the depreciation is for things that you purchased, including the building, the property. You need to spread those things over the life of the particular asset. So it's not necessarily cash. The depreciation accounts for the wear and tear on the asset or the building over time as it's being used to generate revenue. So that's depreciation. Now, how does the IRS decide how much time to assign for depreciation? It's a good question. It's like, I have this fridge, I have this appliance, I have this investment property. How do we determine what period of time to spread that particular cost over, right? So the IRS assigns a standard length of time for these things. So for long-term rentals, it's 27.5 years. For a short-term rental, it's 39 years. For other types of commercial properties, also 39 years. Now, you might say to me, well, Sean, that's kind of weird. For this property, which was built in the 1980s, why would the IRS automatically assume that everything in that property will immediately, last 27.5 years? Now, you would be right in asking that question, and Kelly is going to cover this in a bit more detail in the cost segregation section. So just bear with us, but this is how the IRS determines what the length of time is, and the IRS publication is 946 if you wanted to look it up. Now, so most people would look at this and say, well, here's the thing, Sean, you just told me that I lost money on my rental property. The reality is I got into doing real estate to build passive wealth and make money, right? Positive cash flow, that's what everyone talks about. Here's the thing. Let's make a little bit more extreme example. What if I had $30,000 in rental income, $160,000 in expenses? In this case, I have a $130,000 loss. Now, if I had $150,000 in rental income, that means I would only have taxable income of $20,000, right? So estimated tax savings on this would be about $41,000. That's a big number, but you might still say to me, but wait a second, I still lost money. So how does that really work? Well, as I already mentioned to you, depreciation is a non-cash number. So if the bulk of this number was made up of depreciation, you might be looking at this a little bit differently. That doesn't impact cash flow, okay? So not everyone is eligible to do this thing that I just showed you, which is offset your passive income with your losses from your rental property. You need to meet specific criteria to do this. So I'm going to take you through that now. It's based on two factors. One, what kind of rental property you have. And then secondly, how much you participate in managing those rental properties. I'm going to make this really simple for you. If you have a property manager or you're not actively involved in managing the property, it's unlikely you're participating. And so what I just did here to offset non-passive income, you definitely can't do that. So that's really easy for your situation. However, if you are materially participating, and I'm going to cover what that means in more detail, or a real estate professional, then it's likely that you would be able to use these losses to offset your non-passive income. So let's dive into these two sections in a bit more detail. So if you have a long-term rental, the losses that you're able to take per year, so this, 130K, those losses cannot exceed $25,000 per year. And so if it's bigger than 25K, which it is in this example, we would carry those losses forward into future tax years to where we could potentially use them. And if we can't, we can use them to offset capital gains when we sell the property, okay? However, it is 25K per year. If your income is over $100,000 or more than $150,000, then those losses will be limited. So between 100 and 150, this 25K per year gets smaller and smaller until it's completely zero when you make more than $150,000. So if you make more than 150K, you have a long-term rental, you can't use these losses to offset W-2 income or non-passive income in the year that you made more than $150,000. You would carry them forward. Okay. Now, what about if I have a short-term rental and I'm material participating? Again, I'm going to talk a bit more about what material participation means. You'll notice here that the rules are different. There is no 25K cap per year, and there is no income limitation here, right? And so as a result, generally the losses that you can take against W-2 income, which is in this situation, are a lot less limited. So if we had a short-term rental and we were materially participating in this situation with 130K loss, we could offset 150K in W-2 income and actually explore this, this tax strategy. So finally, I will talk about, I'm going to dive into detail on material participation and the real estate professional. I just want to point out before we do that if you have a long-term rental and you're a real estate professional, those loss limitations, the 25K per year and the income limitation, they go away, right? So having a long-term rental and being a real estate professional would allow you to enjoy the tax benefits of this scenario. Okay, finally, you'll notice here, real estate professional with a short-term rental doesn't change that much. Now I'm going to talk a bit more about what it means to materially participate, right? Now that we understand if we materially participate and have these different types of properties or a real estate professional, there's some big tax benefits. Let's talk a bit more about what it means to be in this center column and materially participate. So there's technically 7 tests that you need to meet one of them each tax year. So you have to do this test every year. There are 7. These are the 3 most common. So I didn't take the time to present these other 4. If you'd like to see those, feel free to reach out and we'll be happy to provide them. Okay, so the first one is you need to do 500. What was that, Kelly?
I was going to say, these are the 3 most common, and it's extremely rare that we see the other 4.
Yeah.
And that's why we haven't included them on this one.
Okay, yeah, absolutely. So Phil, yeah, we're going to cover that, your question on material participation at the end. So that's a great question. And then Ben, yeah, we have a question. Yeah, so we're going to talk about what hours contribute to material participation, like what tasks. So we'll cover that later. So basically, to meet material participation, you need to do technically one of these 7 tests per year. The first one is that you do more than 500 hours, okay? The second one is that you're basically doing everything. I'm paraphrasing here. And the last one doesn't say that you have to do everything. You just need to do 100 hours per year. But you need to be at least participating at least as much as everyone else that's involved in this property. So if you have cleaners for your short-term rental, those kinds of things, you need to make sure that they're not participating more than you. On the real estate professional side, so just refresh your memory, that's this column here. So for someone to qualify as a real estate professional, you need to do more than 750 hours in real estate per year. And here's the kicker: it needs to be more than half your time. Okay, so for a lot of people, so let's say for example, you're a software engineer coding at Google 50 hours a week, right? Or a software engineer. It's unlikely that if you have a full-time W-2 job where you're working 50 hours a week, that you would qualify for this, because the IRS would look at that and say, okay, so if you're doing 50 hours a week at Google, you need to do 51 hours a week in real estate. That's a 101 hour work week that you need to do each week for the entire year. The IRS would look at that and say that feels pretty unsustainable. So it's something to be aware of. Finally, you need to be at least 5% owner if you're working in a business. So say, for example, you're an employee at a property management firm, but you don't own any of it, then you don't qualify as a real estate professional for the time that you spent there. Okay, so now that we talked about what criteria you need to meet in order to be able to take advantage of these tax benefits, I'm just going to recap here that if you have rental properties, 30K in income, 160K in loss, it is possible to have this 130K offset your non-passive income, so W-2, 1099, so on and so forth. You do need to meet the criteria. And now that we kind of understand that depreciation could be part of this number, you realize that you could be cash flow positive still, have losses for tax purposes, and leverage these tax savings. I know that, so I tried really hard to lay this out in a way that's kind of simple with the tables and the information kind of streamlined. The reality is that tax is pretty boring, and complicated. We know that, and so as a result, we built this software planning feature for real estate investors that does all of this for you, right? So you put in your properties, you say whether it's short term or long term, and then it will tell you whether or not you're eligible to take these tax savings and what the potential tax benefits would be. Just at a very simple high level number, it also breaks down the reports, a report for you that kind of tells you how we ran those calculations. If you're a data scientist or just someone that loves to look at the detail, which not everyone is. Okay, so I talked a bit more about, so I took you through at a high level how the tax strategy works for different type of properties, how to materially participate, the real estate professional status. I'm now going to turn it over to Kelly to talk a bit more about how we can leverage the depreciation, right? Because not everyone wants to lose $130,000 in cash on the rental. So how could we leverage this depreciation, accelerate depreciation in a way that helps us increase our tax savings on our rental property? So he's going to dive into the cost segregation study now.
Awesome. Thanks a lot, Sean. And if anybody's wondering on the call, I'm not much of a data scientist either. And that's actually one of the reasons I love that tool, is just because it means I don't have to crunch the numbers. I don't have to dig through everything. And I can still see how we're getting to those numbers. All right, so it's kind of key to the strategies we've talked about, such as the short-term rental loophole, real estate professional status, is generating that loss. And like Sean talked about, we don't actually want to be paying $160,000 out of our pocket, which is why we're looking to take that depreciation. And with that, one of the ways that we can really boost our status and boost that depreciation is using a cost segregation study. So one of the examples Sean talked about a little bit there was actually using a refrigerator. So when Sean went back to, actually, let's go back to that page for a second, Sean, with just the depreciation schedules. So when we're looking at this, as real estate investors, as homeowners yourself, you know that everything in the house isn't going to last 27 and a half years, and it's definitely not going to last 39 years. So if I was to go out and buy a brand new fridge tomorrow, the chances of it lasting 39 years, practically zero. So the IRS would actually agree and say they know everything within that house isn't going to last that long, but we need a way to show that it's going to break down faster than other items. And that gets us off of what we call straight line depreciation and allows us to take what's called accelerated depreciation. And that's really where a cost segregation comes in. So let's go back to that first slide, Sean. All right, so what a cost segregation study is it's just a report and it's going to do what we just talked about. And it's going to take those different aspects of our property, such as the fridge, and put it into different buckets. So we know the roof and the fridge are going to break down at drastically different rates. So the cost segregation is just going to break it down in those smaller pieces and allow us to take advantage of them. So let's go back up one slide, Sean. So we know this can be kind of confusing. Like I said, I'm a real estate investor just like you guys. I started out probably at a lower level than even you guys are at right now. And as a result, I knew how kind of confusing cost segs could be. So what we did is we actually took a real life cost seg study. This is one that one of our former clients actually brought to us, and they gave us permission to use. And we're going to take you through this to show you how they were able to optimize their portfolio and really where they got all of their depreciation. And hopefully that'll answer some of your questions and make this make a little bit more sense. All right, let's go ahead and go down to the next slide. All right, so how do we calculate depreciation on the property? So the first thing we're going to do is we're going to take the purchase price. In this case, it was about $800,000. And then we're going to subtract the land because land doesn't depreciate. We might have things on the land that do, but the land in itself does not. And as a result, so when we take the $800,000, we minus the land value that was $100,000, we're left with $700,000. And that's what we're able to depreciate over that 27 and a half years or over that 39 years, depending on the category that it falls into. So now, if we were to get a cost segregation study, we're going to start in the exact same way. So we're going to take that $800,000. We're still going to subtract the land value. That leaves us with $700,000 that we can depreciate. But then we're going to take that $700,000 and just break it into smaller brackets. So if you look at the screen, we have the refrigerator. That's going to be put into our 5-year bracket. Same as our furniture. Some of the electrical is going to be in the 15-year bracket. That brand new kitchen reno or bathroom reno is going to be in the 7-year bracket. And then even the landscaping outside of it is going to break down too. And that's why it goes into the 15-year bracket. So now let's go ahead and take a look at what would happen if we took straight line depreciation versus if we did a cost segregation and took that accelerated depreciation there. All right, so here is just without a cost segregation study. So here over the course of 5 years, we're just going to take that straight line depreciation, which is going to be $18,000 a year. And if we combine this with one of the earlier examples, such as the short-term rental loophole or the real estate professional status, we're actually going to be able to deduct $18,000 a year and write that off as a loss. So even though we may not have upgraded any of the appliances or done anything to take that, this is the paper expense that we get to actually depreciate in that year, and we can use it to offset our taxes. So $18,000, definitely not bad, and definitely can go a long way. But let's go ahead and take a look at what happens if we use that cost segregation study. So if we took that exact property like our client did, we're going to be able to deduct those values, such as, you know, the fridge being deducted over 5 years or depreciated over 5 years. And then we can actually take $30,000 in that first year just by using that accelerated depreciation schedule, which is going to be a difference of $12,000 just by getting that piece of paper. That allows us to take those based on the useful life of our appliances and of the property. Now, there is another thing that many of you guys.
So what I would say is, this is not like depreciation is not something that people usually find really exciting, much like taxes. But I do feel like this, if there's any part of this presentation which will really blows people's minds, this is the point that blows people's minds because this is what generates huge tax savings, right? All of the other things that we talked about building up to this moment, this is where the huge losses come from. So if you pay attention to any part of the presentation, this is the bit to pay attention to. Go for it, Kelly.
All right. So now coming back to our example, there's also something called bonus depreciation, which most people have heard about, but they don't have a great understanding. And the IRS has come out and said that if the appliance, such as the refrigerator or that brand new bathroom renovation, has a useful life of 20 years or less, we can actually go ahead and take that entire deduction or that entire depreciation in the first year that it's available to us. So now we could take the sofa, the chairs, the renovations, and the landscaping and take all of that in a single year. And let's go ahead and take a look at what happens when we do that. So without a cost segregation study, you would have been able to deduct $18,000 against your W-2 income. Using that, we're now up to $30,000, which is great. But if we take that cost segregation study and pair it with bonus depreciation, boom, we're sitting at $122,000 that could be used to offset our active W-2 income,
Yeah,
with
this is
huge.
the big, yeah, this is the big moment as well. So let me scroll back to our our original example here, where this sounded pretty unrealistic, right? Where it's like I make 150K a year, I have 130K loss. So like, what rental property loses $130,000 and doesn't have all of that coming out as cash out of the bank account? This can make it feel a little bit more realistic. And obviously, you need to meet those criteria on the short term, long term, material participation, a real estate professional status. Okay, Kel, I'll turn it back over to you. Sorry for the interruption.
Oh, no problem. I was getting some of my San Pellegrino, and you definitely caught me. So, all right. So before we run out and get a cost seg, we need to understand, there is some other aspects to it that we need to be aware of. The first one is there is depreciation recapture, which is 25%. So if we were to take $100,000 of depreciation, and then we sold that house, we could be liable to pay back $25,000 in taxes. Now, there are some other strategies that we can use to kind of mitigate this and push it off. The other thing is we are borrowing that depreciation, that $122,000 from the $700,000 total, and we can't magically recreate depreciation. There are some other aspects to this, but it's kind of beyond the scope of this webinar and this presentation, so I'm not going to go into it.
Yeah,
But
I think that's a good point, Kel. So like the original depreciation that we talked about here, right?
yep,
We basically had the purchase price 800, we subtracted the land value, we're left with 700K. By doing a cost segregation study, we didn't actually magically create more depreciation that's more than 700K. It still will always be cannot exceed 700K. We just pulled a lot of that depreciation that would have been depreciated in future years into earlier years or into year one. So I'm glad that you pointed that out.
all right. So another question we constantly get on cost segregation studies is when is the best time, or when do I need to get a cost segregation study done? And the IRS has come out and said that as long as that is done before you file your taxes, so if that's March 15th for an LLC or April 15th for an individual, as long as we have that cost segregation study finished, we're able to take that depreciation right then and there. Now, with that, cost segregation companies are very similar to tax companies where they have a busy season, and that is January to March, maybe January to April. So we always recommend, just like taxes, we want to be proactive and lean into it and get that cost segregation study done as soon as possible. So the sooner we can do it, the better it's going to be. And then I'll go through the different types of cost segregation studies, as well, as this can be a little bit confusing. So we've broken down the cost segregation studies into two types, which you can kind of see as in-person versus self-service. So I'll start with self-service. And with self-service, basically you're going to take all of your information, such as how much you paid for the house, the apartment, or the building. You're going to plug it into a computer. It's going to ask you questions such as, is there a swimming pool? How big is the deck? And then within 15 minutes, it can go ahead and generate that cost segregation report. This usually is about $500 to $1,000, depending on the size of the property and how complex it is. Generally, it tends to be pretty straightforward. So the other option is having an engineering firm or someone with experience come out to your house. They're going to walk around, they're going to take pictures, and then they're physically going to break all of that property into smaller pieces and put it into the buckets that we talked about, such as the 5-year, the 7-year, the 15-year, and the 30-year. With that, they're able to get more detailed when they do it. So they can go ahead and they can look at windows, they can look at the moldings around the windows, find the smallest crack, and give you more options. So with that, we need to understand that the engineering firm is going to be more expensive because they're actually coming out. And when they're coming out, they might actually be able to get you more depreciation. So that can be value added. Now, it's also going to take more time. So if you have to schedule an appointment with a cost segregation specialist, they're going to need all of your financial information, such as documentation on the house. Then they're going to need to schedule travel, come to you. They go back to their office, gen up the entire cost segregation report, and send it back over. So while self-service options usually take, they can be done in 15 minutes, engineering reports or someone coming out to your property, the longest I've heard of this taking is 8 weeks. And with that, they're absolutely going to be slowed down by tax season and their busy season as well. So keep it in mind. Obviously, the upside of having an engineering company come out is they can save you more money, but we just need to be able to balance that out. We
Okay.
have worked. Oh, go ahead, Sean.
Yeah, so just to make sure I understand this correctly, so the timing on getting the cost seg, maybe between January and April, is going to be a little bit busier. The engineering firm is going to be less available. So if you're planning to get this thing done, you've already placed your property in service. Maybe it's better to get a cost segregation study done during the year January to December to avoid the bottleneck. And then choosing between self-service and an engineering firm really comes down to what, Kelly?
I guess the amount of time that you have, the amount you want to pay. And then I'd also point out the complexity of the property. If it's an older house where you're not entirely sure, they might be able to come out and then create a better cost seg, a more accurate cost segregation report that in turn will give you more depreciation to use to offset your W-2 income. The other thing is when we're looking at self-service reports, they tend to be a little bit more conservative just because they're based off of statistics. So they are, in this case, $500 cheaper. Now, the engineering firm that comes out might be able to save you an additional $10,000-$15,000 of depreciation. So we just need to balance that out with how complex your property is and the amount of time you're willing to spend.
Okay, that's great. So we do have some, so as you can tell, the type of cost seg report that you get and also what firm you use can also impact the outcome. And so we do have some, providers that we partner with. And as a result of that, can get you some discounts and that kind of thing if that's interesting to you. Otherwise, most real estate CPAs will have a tendency to work with kind of either their own cost segregation, providers or, have some recommendations as well. Okay, perfect. Well, I think so throughout the presentation, we've had some questions kind of flowing in. And then we also asked people to submit questions of interest to them before the webinar. So I think what we'll do is, Kel, what do you think? We'll cover the questions that people submitted before the webinar first, and then we'll choose some questions for the audience that have come in throughout the presentation and cover those as well. How's it sound?
Yeah, that's a great idea. Karen just asked a question on cost segregation reports.
Okay.
So before we jump away from that, it might be good to answer that one just while we're on the same subject.
Okay, perfect.
So Karen just asked, I'm considering buying a beach vacation property, short-term rental, and getting a cost segregation study/bonus depreciation after meeting material participation. How much is land value in general of total property price? I've heard upwards of 50-50.
This is so this is a really interesting question, Kel. And I would say Uh, we do hear this question frequently at the time when we're preparing people's tax returns. This comes up a lot. Is like, so just make sure I understand this. How do you value the land versus the building
Mhm.
mix? Yeah. So I can take this one. So there's a couple different ways that you can do this. And I would say starting with the worst way, no, which is I would not recommend. You take, so there are some, some big firms out there who are doing this where they just take like, 20% of its land, 80% of its building. Here's the problem with doing that, right? Doing the 50-50 or the 80-20 is some of these beach properties or other people's properties have like 1 acre of land, right? And so, and like a tiny house, clearly the 1 acre of land, depending on where it's located, will be worth a lot more than like a property built on the exact same building built on, say, like 6,000 square foot uh, property. So I don't think using the percentage is a very good approach. That being said, some CPAs, national firms out there are doing this, but for the reasons I already explained, this isn't the best approach. I would not recommend it. The other approach that you can use is you can ask. So a lot of times when you're, so I'm talking about these in order of preference. So the other approach that you can use is, so the first one, not recommended. Second one, you can use, but not the best, is when you go out and buy the property, a lot of times um, you'll get a inspection, right? And you'll get like kind of evaluation on the property as part of it. Uh, those are usually from reputable firms, and so you could use this as a way. A lot of times, the land value is also broken out in that valuation, so you can use that. Um, it's also at the time that you purchase the property, so I would say the timing on it is pretty up to date, pretty accurate. So the third way that you can use, and I think that this is probably the preferred approach, right, is you go to the county assessment. So this is the same place where you go to pay your property taxes, and you look at the accounting assessment. They have trained people. This is the job that they do day in and day out. They look at the land, they look at the value of the building or the improvement that's been done on the land, and then they split the value between the two, right? So go to your county assessment. Usually you can search your county name plus property taxes or assessor. You can get to a place where you can search for the property address, and then you'll be able to get, it will show like a split between the land and the building. Not all of the counties have really great accessible websites, so that's where you might have to, either go in person, write them, call them, if you can't do the search, or explore, one of the other options that we talked about. But this is the best approach. And so what you normally do is you don't take the land value that's on the county assessor website. You actually take the percentage split, right? So you look at the split of the land versus the building. What is the ratio, right? And then you take that ratio and you multiply it times the purchase price at the time that you bought the property. And that will give you the split between the land and the building. We obviously don't depreciate the land, like Kelly already talked about. So we just depreciate the land depending on what kind of property it is. So do you think that answers her question, Kelly?
I think so. So follow-up question on that. Obviously in 2024, depreciation is phased out at 60%. Do we think that is going to go back up to 100%? Do we think that's going to go down? Let's go ahead and get your expert opinion on that one.
Yeah. So wow, if I had a nickel for every person that asked this question while I was preparing tax returns between January and April, I would be a very rich person. This is a hot topic. Some people even filing extensions because they were thinking that maybe this law would pass during the time that they, you know, this law would pass during the time.
The 6-month extension.
Exactly. Yeah. So if they filed an extension, that maybe the law would pass and they would be able to then qualify for 100% depreciation. So background on this question, 2022 bonus depreciation was 100%, right? It's now phased down to 80% in 2023, 60% in 2024. What is the probability? So I would say the bill that you're talking about, and so in this case, Karen, I can send you the law, right? So the bill that's actually in the Senate right now, I can actually send you to the place where you can track the progress on that bill. Right now, it passed the House. So good news is it passed the House. The next stage of that will be that it needs to be voted on and pass the Senate. It's not on the floor yet, so it's kind of got installed a bit in the Senate. But once it gets passed by the Senate, it would then get signed into law by the president. So we still have two more stages that particular bill needs to go through in order for us to know whether or not we could get to 100% depreciation for 2024. That being said, I haven't heard a lot of people saying that they didn't think it would pass or that it would pass. So I would say there's some uncertainty there. But I can definitely send you directly to the Senate website where there's a tax bill tracker for that particular bill. And then that will keep you up to date on what's going on, since it sounds like there's a bit of uncertainty on your side. But yeah, a lot of people asking about this, waiting to see what will happen. So you're not alone. I would say quickest way to research this is just to go into Google and then Google 100% bonus depreciation tax bill. And then you can very quickly find when the last article was published. The other way is I'm going to send you, the tax bill so that you can track it yourself directly from the Senate website. And anyone else who wants that, if you could just comment in the Q&A, I'll also send you an email with that tracker in addition to sending it to Karen.
All right. So I say before we jump into some of the other questions that popped up, let's go ahead and kind of prioritize questions that were sent in beforehand, as I know a couple of people put in a lot of effort into those.
Okay.
So then we're just able to get into those and maximizing our time.
Okay, perfect. So let me start with, so these are the questions that we selected. So Kelly, why don't you kick us off? When is the investment property considered placed in service?
Yeah, so this is one we get a lot. And according to the IRS, the property is considered placed in service when it's ready and available to rent. So if you were to go ahead and place an ad on an Airbnb website, if it's short-term rental, if it's long-term rental, if we were to place that ad on Zillow, that's when we can start deducting those expenses. And then if we had minor kind of expenses after that, such as small repairs or something, after it was listed, we could go ahead and deduct those expenses as well. But in general, they're going to want to see that property completely in service and ready to be rented out.
Yeah, so I agree. Common misconception is people think that they have to have a tenant, right? Or that the guest already has to have stayed in the property. As you pointed out, you really just need to have the place available. If it's a short-term rental that doesn't have any furniture, somebody tells me it's not ready and available, right? Like it needs to actually be ready. People don't have to have necessarily have to have had stayed in the property. Sometimes it takes a couple of months to find a tenant for a long-term rental.
Right.
That's just how it is. Okay, cool. I will take the next one.
All right. So can you combine material participation hours, such as, let's say, you put in 50 hours of material participation and then your spouse goes ahead and puts in 50 hours of material participation into those rental properties?
Okay, yeah. So we get a lot of people who are real estate investors, married, filing joint, right? And then they, co-invest together. I mean, obviously, life is busy. Not everyone has the ability to put in 500. So the short answer is yes. If you're, married, filing joint, you can combine the hours between the spouses on the tax return to get to your 500 hours. Obviously, those tasks that you're completing need to count, but ultimately, yes, you can combine them to reach the material participation thresholds that we talked about earlier in the presentation. All right, this one's going to be for you, Kelly. I know you want me to take this one, but you're going to take it.
I do want to jump in on that, though.
What's that?
I do want to jump in on that last question.
Okay, go for it.
So in the rep status, that's where you have to meet those two thresholds on your own, such as the 750 hours and more than half of your time. That's something that we have to meet individually.
Yep.
So if you hit 750 hours and it's more than half of your wife's or your spouse's time, then that's not necessarily going to count. And we've had a couple of people fall into that trap as well.
Yeah, so I think what you're saying is like if you're trying to do material, if you're trying to hit real estate professional status, you have to hit it on your own individually. Uh, so that's what I think you're clarifying, and so thanks
Yeah.
for that. I think what there, if you're just trying to hit material participation, you can definitely combine the hours between, if you're married filing joint, you can definitely combine the hours between spouses to try to meet these thresholds to material participate. But that's not the same for real estate professional status. So thanks for pointing that out.
Right.
Okay, let's see. What hours count for material participation? This is a really common question that we get. Also, let's just recap. You can't, like, if you really want to employ this strategy, you need to meet the criteria that we talked about. And so to meet this criteria, one of the big ones is material participation. And so in that case, it's important that we talked about like how to reach that, what tasks we can do to meet that. So let me go back here. Okay, Kelly, go for it.
All right. So, like you said, this one's a pretty common question. And we could actually do a whole hour, probably a week-long webinar series just on
Probably not a week, yeah, but okay.
what counts for material participation. So that's why we actually wrote a blog post. And if anybody's interested, here's how you get to our blog. This is where it's at. But the rule of thumb that I kind of point out is when you're looking at the service or the task that you're doing, ask, is this kind of instrumental in running that property? And if I was to not do this task, would we still be able to run this business, such as, booking in clients? Obviously, that's something we need to do. We need to be cleaning the property. Some of the other stuff that kind of falls outside of that, such as research hours, such as looking at property on Zillow, it's not going to count. If I don't look at properties on Zillow on my lunch break, are we still going to be able to book in clients? And the answer is, yeah, we'll probably still be all right. But on that blog post, you'll be able to see what counts. There's a list of activities that counts, and also some of the most common ones that aren't going to count. So you guys can go ahead and kind of do a deep dive there on your own. And then if you have more questions, go ahead and hit us up. All right. So
Okay.
next question. Oh, sorry, Sean, did you want to jump in?
No, go ahead. Yep.
All right. So next question is kind of in the same vein. And that's, how do we track material participation? And what do we need to do to track it?
Yeah, I think so. You need to meet this material participation test every year, right? And as a result, you're kind of doing this throughout the year, January to December, right? Performing these tasks that Kelly just talked about. It's pretty hard. Like, let's say you submit your tax return for 2023, right? So the tax period that just passed, you submit it sometime in like May, you know? It'd be pretty hard for you to remember what you did in January of last year on this rental property. And if the IRS is asking for contemporaneous notes that show what you did in order to meet this qualification, and if you can't provide that, they're going to claw back all of the benefits that we just talked about on the tax side. It's kind of important that just keep like a simple tracker. And so what I would say is the IRS is pretty clear on what they require. They basically want to know what you did, what date you did it on, and they have like a format that they also provided. So I'll quickly show you that here. We also have a sample tracker. It's completely free. Basically, just click here and you can copy a sample of it. But the IRS, so as I mentioned, they actually break this down in detail for you, like what you need to do. Here's the IRS audit techniques guide. So this is the guide that they actually give to their auditors to say like, hey, these are the things that you should ask for when you're auditing a real estate investor to make sure that they materially participated. So I would encourage you, so yes, keep good records. That involves tracking what you did, when you did it, how many hours you spent on it. It is important. I think some people dismiss this and are kind of like, it doesn't really matter. It actually does. And it's pretty simple to do. You just need to keep at it throughout the year and keep good records. Anything you want to add to that, Kel?
No, you pretty much covered it. I know it can sound kind of scary, but go into all of those records with kind of the belief that they're going to be scrutinized in court. If we are able to deduct $100,000, see that almost as a $100,000 court case, where you're going to be asked to defend that. And if $100,000 is on the table, you're going to want to be pretty specific. One of the things I tell clients is when I leave in the morning and I head into work, I don't plan on getting in a car accident, but I buckle my seatbelt every single day. Uh, and it's just a good precaution. Worst case, you don't need to do it. But if you're ever in a bad spot, you're definitely going to wish you had. So just keep detailed records as good as possible and think about how you can substantiate it if you need to.
Okay, perfect. I think it's a good analogy. I like it. Who wants to take the
Right.
last one? Me or you?
I'll let you take this one as you have a little bit more experience with HELOCs or HELOCs. So what's the best way to show the HELOC loan from primary residence is for an Airbnb? And does that Airbnb need to be in an LLC?
Okay, I'm gonna do this in two parts. Good questions, by the way. I would say the second part of this question really common. I do it in an LLC. So I'm gonna cover the first part first because it's gonna be shorter. So if you have a HELOC, so you basically, you have a primary residence, you take out a loan against the equity that you have on that primary residence, and then you invest that money into like to another rental property or an Airbnb, a short-term rental. So it's not being reinvested into your primary home. You're using it for something else. If it is used for the Airbnb or to fund the rental property, you can deduct the interest on the HELOC on your rental property expenses for your rental, right? And so where does it go? It goes on the line item for mortgage expenses, mortgage interest expense, or it can go in other expenses. If you need more detail than that, and I'm happy to provide an example like the IRS Schedule E, or if you're reporting this on an LLC, I can tell you where to report it on the Form 8825. But at a high level, short answer, if the HELOC is used to fund the rental, you can deduct it. You can deduct the interest expense. Short answer. Does the Airbnb need to be in an LLC? I could think about this in a couple different ways. Like, okay, so does it need to be in an LLC to do the deduction? No, right? If the HELOC was used to fund a rental property, it does not need to be in an LLC. You can still deduct it on the IRS Schedule E as long as you used the HELOC funds, all of the funds. If you used a portion of them, only include the interest for the portion you used. You can deduct it. So it does not need to be in an LLC. It does change how you report it. You need to report it on a different form. But ultimately, you can still deduct it whether it's in an LLC or not. Does the Airbnb need to be in an LLC? Think about this from the perspective of, I'm a real estate investor. Should I have my investment properties in an LLC? Lawyers and accountants will always tell you yes. The reason for that is we're risk adverse, right? Like we're trying to help you minimize the risk to the business. And so if you don't have your rental property in an LLC, and unfortunately someone falls down the stairs, really hurts themselves at your rental property, or the place burns down with someone inside, and they can prove that you didn't have proper fire precautions, ways for people to exit the property, they can sue you personally, right? They sue the person that owns the rental property. So if the property is in your personal name, all of the assets that you personally own are now on the table in that lawsuit. If the LLC owns the rental property, then they will sue the LLC in that situation. And then all of the assets that the LLC owns will be on the table for that lawsuit. So you can kind of see how having an LLC provides this layer of protection between you, between your rental property and your personal assets. In addition to an LLC, most lawyers and accountants will also recommend that you get insurance. Like you absolutely need to have insurance to protect yourself. If something happens at your rental property, there's a lawsuit, and it's covered by the insurance, then that's great, right? If the lawsuit value exceeds the insurance, what the insurance will cover, then they're going to go after the assets that the LLC owns if it's in the LLC owned property. So, the rental property. If it's in your personal name and the lawsuit exceeds the value of the insurance policy, then they'll go after your personal assets. So hopefully that answers the question all around for, does the Airbnb need to be in an LLC? Probably more information than you needed. Also don't want to end on a dark note. Like that was kind of like people burning down inside the property. That's a super dark note. So let's not end on that. We have had people submitting other questions. And we spent a lot of time answering the ones that people submitted in advance. So thank you for that. What do you think? Do we have time for a couple more questions?
Yeah, I think we got time for one or two questions. So this one's coming from Sharon. It
Okay.
says, I'm a W-2 employee with a short-term rental. My CPA won't let me use cost seg to offset W-2 income and wants to carry the losses forward. What should I do?
Okay. I love to use illustrations to answer these questions. So rather than just tell you in words, I'm going to go back to our deck here. And so in this situation, what we're basically saying is like the CPA needs to evaluate what kind of rental property it is, how much they participate, or if you're a real estate professional. So Sharon, if you feel like you're meeting the requirements for material participation, or you're, a real estate professional, depending on what kind of property you have, you feel pretty confident that you qualify for the deduction, then I would say reevaluate now based on the information that you have. But just also, secondly, let me show you what the CPA is saying. If you had losses of say 160, if you had expenses of 160 and losses of 30, you would then, instead of being able to deduct them and offset them, you would carry them forward. So I would reevaluate whether or not you qualify. One of the other things that we find as well is I never really defined what a short-term rental is here. So I'm going to do that now based on this question. Again, want to be absolutely certain that you qualify. So short-term rental is something average 7 days, right? So guests can stay for 1 day, 15 days, but it needs to average to 7. You can't use it for more than 15 days personal use. So if you have a nice property near the lake, you want to use it yourself, that's totally fine, but it can't exceed more than 15 days. Finally, not longer than 30 days on average, right? So sometimes people have these short-term rentals that are near hospitals. So traveling nurses come and go. And so throughout the year, if on average they stay for more than 30 days, that disqualifies you as a short-term rental. So thanks for that question, Sharon. Hopefully that answered it for you.
All right, so we got 3 minutes left.
Okay, one more question. Let me see. Okay, I'm gonna go with question from Ben.
Okay.
Okay, Ben. First, thanks for hosting this free webinar. Super helpful. I'm not trying to decide. I'm now trying to decide if my material participation based on info you shared. Would attending this webinar or doing education classes, all of that stuff, does that qualify for material participation?
Yeah, so good question. Like we said, it's kind of a complex topic when it gets to material participation. I would say if you're at the point where you're trying to figure it out, trying to see if you qualify, feel free to reach out to us. We'll deep dive those specifics with you and we'll go through really your specific situation. We can do that on a consultation call as well. When it comes to does this webinar count towards material participation? Unfortunately, the answer is no. I wish it did. I think we all wish that, looking at properties on Zillow, which I'm sure most of us have as kind of a guilty pleasure, counted towards material participation. But that's going to be more in the realm of education hours, which the IRS isn't going to see as being necessary to running that property, to getting those customers in. And then, once again, that kind of analogy, if we didn't go to this webinar, would it be impossible to book clients? And that's why, unfortunately, the answer is this isn't going to count. So sorry, Ben. Hope you still got a lot out of it. But we can't put this one down on your activity tracker this time.
Yeah, and thanks for that, Kel. So for any questions that we didn't get to, thanks for submitting them. If they're quick answers, I'll send you an email, or Kelly will send you an email directly just to quickly answer them. Otherwise, we're going to answer them. We do these webinars on a regular basis. We'll do a specific webinar that covers the short-term rental loophole or depreciation, and we'll cover them in those segments. So thanks for taking the time to attend. Hope you have a great rest of the day.
All right. See you, everybody.
See ya.